Let's talk a little bit here about some of the repositioning that we continue to see in the fixed income market. This was a market that, I don't know, a few months ago was pretty much dead set on this idea that rates were going to come down and come down meaningfully. That seemed to have stalled out just a little bit. And now you're starting to get a resurgence in inflation, and some people are saying, okay, maybe cutting rates further is appropriate.
Yeah, no, certainly it's been a volatile market here, particularly from the rate side. I think the credit market's been quite stable, incredibly stable. But on the rate side, we've had to really price in quite a lot of different data, economic data, Fed speculation, now the election. So it's not too surprising, perhaps, that we're seeing things moving along. But I think to your prior segment here, now inflation is coming back into the mix more and more. And, before election, I think the market was increasingly starting to focus on the job market, less so inflation. Now with the election outcome, the data today, there's a little bit more of a balance here that we would expect both the Fed and the market to kind of
But a lot of the strategizing and the modeling was, at least prior to the election, pretty much just about where the economy was and what the reaction function by the Fed would be. A lot of people now are obsessing over what policies come out of the White House and maybe Congress. Do you think that will have a major impact on where rates go, or is that just sort of part of the broader tapestry?
No, I think it's going to have quite a major impact on where rates go. And we've already seen that move, right? From pre-election to now, we were expecting, if we were going to have this kind of red sweep that we formally now have, that rates were going to move up quite quickly and the curve steepening a little bit. In fact, we were a little surprised that we hadn't seen more. We've been kind of expecting sort of 4.5% on the 10-year.
That we hadn't seen more of an upswing in rates.
Yeah, I think the initial reaction was, pretty dramatic, and then the rates started coming back down. We're seeing that kind of changing back a little bit in the last couple of days. But there's no question that we need to get more clarity around what the policies will be, particularly around tariffs and taxes and immigration, what have you. And the market is trying to price all that in.
Are you one of these people who thinks we're going to 5% on the 10-year?
We are not. We're expecting sort of 4.5, maybe plus minus 25 basis points. So we're getting closer to more probably fair value at this point.
So you mentioned credit, so I want to pick up on that because credit spreads have narrowed. In investment grade, it's the lowest since 1998, that spread. In high yield, it's the lowest since 2007, before the financial crisis. Has the market priced out all risk of volatility here?
I mean, I would say for sure the credit has been very stable if you compare to rates, and I think for good reason. The economy is holding up incredibly well. We're marching towards a soft landing. This red sweep kind of suggests that corporate fundamentals going to hold up quite well, taxes backdrop, what have you. So from that perspective, I would call it's been fairly well justified. We are actually quite comfortable still with credit. We've been favoring credit over rates for some time, just because there's been so much volatility on the rate side. I would say investment grade is starting to feel a bit on the rich end, to your point. High yield is a little different in that if you go back to, kind of a few years back, it was more single B weighted. Now it's more double B weighted.
Okay.
So you're comparing a little bit apples and oranges. So from that perspective, it seems a little bit more rational. I would say leveraged loans is an area that we're even more excited about right now, giving, again, a little bit of higher for longer kind of type rate environment, and getting close to 9% yield in that space is an area that we're particularly focused on.
So you talk about investment grade versus high yield. Barclays sees anywhere from $40 to $50 billion of fallen angels next year. Companies like Boeing and Paramount potentially losing their investment grade credit rating and moved into the high yield index. What kind of distortions does that create? Because they'll be a bigger part of the high yield index. And what kind of opportunities does that create too?
Yeah, I mean, I would say fairly, I wouldn't call it all that meaningful distortion necessarily. The high yield market has become really, really quite large. It has dealt with fallen angels many, many times before. So, the benchmark has to adjust a little bit on the near-term basis, but I think the market can see through that quite quickly, and investors will adjust their expectations around that. If anything, it's exciting in that you see quite good company coming down and offering different investment opportunities and diversification opportunities. So if anything, I think it just adds another layer of opportunities that a high yield market will offer going forward.
With regards to the issuers, though, do you think we're going to see more new issuance as an outgrowth of the policies and conditions that we're anticipating next year?
I mean, I would say there's been a lot of issuance this year to date, right? A lot of companies, a lot of chief financial officers have been trying to be ahead of the election, kind of taking advantage of the market, taking advantage of the spreads, quite frankly. So I think you can say we've seen a pretty healthy pushing out maturity kind of wall from that perspective. But I mean, corporate fundamentals.
But those are primarily healthier companies that had the clout and ability to do that, right?
Absolutely. So triple C equities, it's been tougher to basically access in the market. And I think that bifurcation has been healthy. Investors have been a bit skeptical about the more riskier aspects of the market. So all in all, going into next year, I think having stability, election behind us, again, the red sweep is quite positive backdrop from a corporate fundamentals should probably mean more issuance coming.